Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge etc. The Turning Tide, the story of bank nationalization, 19th July 1969. The Pulse of a Nation. India in the late 1960s was a land of contrast. Over 2 decades had passed since independence, and the nation stood at the crossroads of socialism and capitalism. Grappling with poverty, food shortages, and uneven economic growth, villages remained untouched by modern finance, while a small elite controlled the country's wealth and access to credit. It was in this backdrop that one of the most transformative events in India's economic history unfolded, the nationalization of 14 major private banks on 19 July 1969, orchestrated by the then Prime Minister Indira Gandhi. This bold move reshaped the Indian banking landscape and redefined the relationship between the state and its citizens. But this was not just an economic policy. It was a high-stakes political gamble, a clash of ideologies, a fight for social justice, and a saga filled with tension, resistance, and long-lasting consequences. The seeds of discontent. The 1960s were a turbulent decade for India. After the early optimism post-independence, the country was now facing wars, droughts, inflation, and rising inequality. Agriculture was the backbone of the economy, yet farmers had little access to institutional credit. Moneylenders charged exorbitant interest rates, trapping villagers in cycles of debt. While India's 5-year plans aimed at inclusive growth, their success was stunned by the limited reach of formal finance. Of the more than 5 lakh villages in India, fewer than 2% had a bank branch. Most commercial banks were privately owned and concentrated their operations in urban areas, primarily serving large industries and trading houses. The rural and semi-urban poor were invisible in the eyes of finance. The Reserve Bank of India, under governors like H.B.R. Lengar and L.K. Jha, had raised concerns about credit concentration. Data revealed that a handful of industrial houses were receiving over 60% of bank credit. Alarm bells were ringing, but change remained elusive. A woman with a vision. Indira Gandhi had taken over as Prime Minister in 1966 after the sudden demise of Lal Bahadur Shastri. At the time, many considered her a weak figure, a puppet controlled by the Congress Party's old guard, known as the Syndicate. But Indira had her own vision, shaped by her father's ideals and her keen understanding of India's inequalities. She saw banking nationalization as a means to democratize credit, empower the poor, and take control of an economy that was increasingly being cornered by a few business families. It was also a strategic move to consolidate her political authority and outmaneuver the syndicate. In 1967, the Congress suffered severe setbacks in state elections. There was growing unrest and demands for social justice echoed across the country. Indira Gandhi began speaking of Garibi Hatao, eradicate poverty. Nationalization, she believed, was the first big step in this direction. The political storm brews. While Indira Gandhi's intentions seemed pro-poor, her party was divided. The Congress old guard feared that nationalization would alienate powerful business lobbies and destabilize the economy. Morarji Desai, the then Deputy Prime Minister and Finance Minister, opposed the idea strongly. He believed in a free market approach and cautioned that such radical socialism would deter investment and confidence. Indira, however, was unfazed. She knew she needed a dramatic move to assert her dominance. In 1969, she clashed with the syndicate on the issue of presidential nomination. The Congress split was inevitable. Meanwhile, in secret, Indira began consultations with trusted bureaucrats, economists and advisors like P.N. Haksar, D.N. Ghosh and I.G. Patel. A plan was being quietly drafted, a plan to take over the commanding heights of the economy. The Midnight COP, 19 July 1969. It happened like a thunderclap. On the night of 19 July 1969, while the country slept, the President of India, V.V. Giri, signed the Banking Company's Acquisition and Transfer of Undertakings Ordinance. By the next morning, 14 of India's largest private commercial banks, each with deposits of more than Rs 50 crore, were nationalized. These included Central Bank of India, Bank of India, Punjab National Bank, Bank of Baroda, United Commercial Bank, Canara Bank, United Bank of India, Dena Bank, Syndicate Bank, Indian Bank, Indian Overseas Bank, Bank of Maharashtra, Union Bank of India and Allahabad Bank. The news hit like an earthquake. Shareholders protested, industrialists fumed and political opponents cried fool. But the move was now law. The government would compensate shareholders, but control of these banks now rested with the state. The nation reacts. Newspapers were filled with debates. Some hailed it as a historic socialist revolution, others decried it as a disaster for free enterprise. The Bombay Stock Exchange was in turmoil. Business houses who had close ties with bank boards lost access to easy funds. But for the common people, especially those in rural India, there was cautious optimism. Could this really mean banks would now come to their villages? Would farmers, artisans and small traders finally get access to loans without being at the mercy of middlemen? Indira Gandhi addressed the nation. She explained that banking nationalization was not against private enterprises, but for the welfare of the people. She promised that banks would now serve national priorities, agriculture, employment and small-scale industries. From boardrooms to Bharat, bank nationalization was not just a legal decree, it was a logistical mammoth. Overnight, the ownership of 14 private giants had transferred to the government, but the real challenge lay ahead: implementation. The first question was, how would nationalized banks actually serve the rural poor? The Reserve Bank of India and the Ministry of Finance had to coordinate policy with on-the-ground operations. Rural infrastructure was weak. Branches were clustered in cities. Employees had little to no exposure to agricultural credit or microfinance. To respond to this, the government directed nationalized banks to open branches in unbanked rural and semi-urban areas, especially in backward districts. A new mantra echoed across bank headquarters: social control and private sector lending. In practical terms, it meant setting up thousands of branches in rural India, designing credit schemes for farmers, artisans and self-employed youth, diversifying the loan portfolio away from big business, training staff to deal with new customers and local needs. Bank managers were now expected to walk through farmlands, assess crops and finance dairy sheds, a far cry from their former role of approving big industrial loans from their air-conditioned boardrooms. The lead bank scheme, a rural revolution. To systematize this outreach, the lead bank scheme was launched in December 1969. The RBI assigned each district in India to a specific bank, which would act as a coordinator for banking development there. For instance, State Bank of India was assigned large portions of Uttar Pradesh, Bihar and Assam. United Bank of India was tasked with Eastern India. Canara Bank and Syndicate Bank ventured deeper into the south. These lead banks were responsible for surveying local credit needs, coordinating with panchayats and block officers, organizing credit camps and awareness drives, mobilizing savings from rural households. This became the first time many villagers encountered the idea of a bank not as a foreign fortress, but as a friendly local ally. Women, landless laborers, and scheduled castes slowly began entering bank branches, not just as depositors but as borrowers with a voice. The political earthquake, Congress splits. As the banking wheels turned in villages, a political earthquake shook Delhi. Indira Gandhi's bold move had deeply angered the Congress syndicate, especially Morarji Desai and other conservatives within the party. The bank nationalization move, seen as a challenge to the status quo, proved to be the last straw. In November 1969, barely 4 months after the ordinance, the Congress party split into two factions. Congress O, the organization faction led by K. Kamaraj, Morarji Desai, Nijalangappa and others. Congress R, the requisitionists led by Indira Gandhi. Indira Gandhi was expelled from the party by the syndicate, but she responded with powerful oratory, appealing to the masses in the name of the poor and farmers. She now projected herself as the champion of the common man and the true heir to Nehruvian socialism. The split ironically worked in her favor. With support from the Communist Party of India, socialists, and regional groups, she sailed through the political storm and emerged stronger. While Indira won the political battle, a legal war was simultaneously brewing. Several banks and shareholders challenged the ordinance in court, arguing that it violated their fundamental rights. In 1970, the Supreme Court struck down the first ordinance on the grounds that the compensation terms were unfair. It violated Article 19, right to practice any profession or carry on any occupation. Undeterred, the government passed a revised version, the Banking Companies Acquisition and Transfer of Undertakings Act 1970, with improved compensation terms and restructured administrative control. This version withstood legal scrutiny. The final victory was symbolic. The judiciary had given its nod, and the foundation of a socialist banking regime was now legal, political, and institutional. The rise of the Dhan Andolan. Through the 1970s, bank employees were given a new national mission, financial inclusion. Bank staff went from door to door, creating awareness about savings accounts, promoting credit for agriculture, and encouraging small business loans. Credit fairs, loan melas became common. In some states, banks would host week-long credit camps where hundreds of farmers received on-the-spot loans. The slogan of the time became, "Each village must have a bank branch." Some iconic outcomes of this outreach: rural branches increased from 1,443 in 1969 to over 30,000 by 1990. Agricultural credit as a percentage of total credit more than doubled. Self-help groups and cooperative banking received state backing. Poor households, especially women, got access to formal finance for the first time. This was the true beginning of the Jan Dhan movement, long before it became a buzzword in modern times. New heroes in a new era. The faces of Indian banking were changing. Gone were the elitist boardroom directors. Now the leadership included socially committed officers who rose from humble roots and understood the Indian hinterland. One such example was Dr. Manmohan Singh, who as an economist in the 1970s strongly backed policies for inclusive growth and later became the RBI governor and finance minister. Bank officers once restricted to cities were posted in tribal belts, mountain villages and flood-prone regions. Their role was now more than financial, they became change agents. Though there were inefficiencies, loan defaults and bureaucratic hurdles, the intent was clear. Banking should serve nation building, not just profit making. Banking the unbanked. By the mid 1970s, the effects of bank nationalizations were becoming evident. Thousands of bank branches had sprung up in areas previously untouched by formal finance. For the first time, a farmer in a remote Uttar Pradesh village or a weaver in a small Tamil Nadu town could walk into a bank and be treated as a legitimate borrower. Between 1969 and 1991, the number of bank branches rose from around 8,200 to more than 60,000, with rural branches growing more than tenfold. The average population per bank branch fell drastically from 65,000 to under 14,000. Some major achievements during this period included introduction of Kisan credit cards, pilot versions through cooperative lending, support to the green revolutions by financing fertilizers, tractors and irrigation, increased deposits and savings rates especially from low income households, boost to employment generation through small loans to artisans and entrepreneurs. Nationalized banks played a critical role in doubling India's food grain production between 1967 and 1978 thanks to timely rural credit. Banking had become a tool for agricultural self-sufficiency. The human impact, the story from the ground. Let's travel to a village in Bihar in 1975. Ramdhari Singh, a marginal farmer, had just returned from a moneylender's house, where he was offered a loan at 60% annual interest. Burdened by debt and crop failure, Ramdhari had little hope. But this year, something changed. A State Bank of India officer visited his village under the new rural branch scheme. They offered loans for seeds and fertilizer under government-backed agriculture credit program. Ramdhari hesitated. He had never trusted banks, but after attending a Gram Sabha meeting led by the bank manager and the block officer, he agreed to apply. Within 3 weeks, Ramdhari had his first formal loan, Rs 2,000 at 12% interest. That year his yield tripled. The debt cycle was broken. His children continued schooling. By the 1980s, his eldest son had started a dairy business, also with a small bank loan. This was not just Ramdhari's story. It was a reflection of millions of rural Indians who began to see banks not as elite institutions but as instruments of hope. Navigating the Green Revolution and Industrial Credit. The Green Revolution, with its focus on high-yielding variety seeds, irrigation and fertilizers, needed financing. Nationalized banks stepped in as the backbone. They financed tube wells and pump sets, storage facilities and godowns, cooperative farming societies, transport for produce to mandis. Similarly, in urban areas, small-scale industries known as SSIs began receiving dedicated credit. Handloom workers, small foundry workers, food processing units and machine shops started sprouting across towns. Government schemes like Integrated Rural Development Program (IRDP), preferential rate of interest, self-employment schemes for educated youth were all backed by nationalized banks. Despite bureaucratic challenges, corruption and inefficiencies in implementation, the nationalized banks were actively funding the dreams of India's lower economic strata. The emergency and economic discipline. In 1975, Indira Gandhi declared the emergency, a period of political repression but also bureaucratic efficiency. During this time, loan disbursement targets were strictly enforced, branch expansion reached its peak, bank managers were directly accountable to government officers. However, the period also saw a decline in autonomy. Banks, while serving the public, became overly dependent on government directives. There was growing political interference in loan approvals, particularly for politically aligned individuals and groups. The seeds of non-performing assets (NPAs) began to appear. The pressure to lend quickly, often without proper credit evaluation, led to defaults. Still, the focus remained on inclusive finance and nation building over profitability. The shifting sands of public perception. By the 1980s, public perception of banks had undergone a dramatic change. Once seen as elite institutions catering only to the rich, banks were now visible in every district, town and many villages. Posters on the walls of rural branches read, "Hum hath ko kaam, har khet ko pani," work for every hand, water for every field. However, cracks had begun to show. Service quality was poor, branch staff were overburdened and undertrained, loan recovery was weak, especially some unsanctioned loans. Long queues and bureaucracy alienated some new customers. Despite these challenges, nationalized banks had achieved what seemed impossible in 1969, banking for the masses, not just the markets. A global comparison. Globally, India's bank nationalization stood out. Most Western countries had private banking systems. Some communist countries had fully state controlled banks, but India had carved a unique model. A mixed economy with state owned banks serving social goals under democratic governance. This allowed India to avoid the credit crisis seen in Latin America, the overlending to dictatorships seen in Africa, the lack of rural access seen in parts of Southeast Asia. India's rural credit model inspired countries like Bangladesh and Sri Lanka. The dissenters and the downside. Not everyone celebrated the nationalization. Critics argued government interference in bank operations reduced efficiency. Profitability declined as banks were forced to lend at low interest rates. Political misuse of credit led to increasing defaults. Innovation and technology adoption lagged behind. By the late 1980s, the bad loan crisis was emerging. NPAs were rising. Banking bureaucracy had become rigid. Staff unions resisted performance-based reforms. Even inside government circles, a debate had started. Should nationalized banks be allowed to function more independently? The economic crisis of 1991, a moment of reckoning. By 1991, India stood at the brink of economic collapses. Foreign exchange reserves had plummeted. The country was barely able to cover 2 weeks of imports. Mounting debt, fiscal mismanagement, and growing inefficiencies in state enterprises, including nationalized banks, were beginning to take their toll. A new government under P.V. Narasimha Rao, with Dr. Manmohan Singh as finance minister, launched sweeping reforms, liberalization of the economy, opening up to foreign investments, deregulation of industries, reform of the financial sector, including public sector banks. Bank nationalization, while transformative, had now reached a critical inflection point. The government had to decide whether to keep directing banks politically or allow them to compete freely in an open economy. Banking sector reforms, post-liberalization era. The Narasimham Committee reports 1991 and 1998 became the guiding force for banking reforms. Key recommendations included reducing non-performing assets, allowing autonomy to banks in decision making, introducing prudential norms for lending, allowing private and foreign banks to re-enter the sector, merging weak banks to create stronger institutions. The RBI began tightening norms. Public sector banks were pushed to improve efficiency and profitability while still honoring their social obligations. Banks began adopting core banking technology, online transactions and ATMs, risk-based supervision, mobile and digital banking platforms. Although the landscape changed, the foundational role played by nationalized banks in building trust among common citizens gave them a massive head start. Reflections from the ground, then and now. Let's return to Ramdhari Singh's village in Bihar, now in the 2000s. His granddaughter Rekha Kumari runs a women's self-help group that weaves jute bags. The group took a micro loan of rupees 50,000 from the same State Bank of India branch had helped her grandfather decades ago. Rekha's income supports her daughter's education, who is preparing for the civil services. Meanwhile, in a neighboring village, a tech-savvy farmer checks crop prices on his phone through an app funded by a loan from Canara Bank. Digital India has arrived, but its roots go back to the dusty files and pens of 1969's rural branches. The journey from nationalization to financial empowerment is not just economic, it's personal, generational, and cultural. The mergers, consolidations, and modern reforms. Between 2017 and 2020, the Indian government undertook another series of banking reforms. This time it aimed at consolidating public sector banks to improve capital strength and competitiveness. Several nationalized banks were merged. Punjab National Bank with Oriental Bank of Commerce and United Bank of India. Bank of Baroda with Dena Bank and Vijaya Bank. Canara Bank with Syndicate Bank. Union Bank of India with Andhra Bank and Corporation Bank. While some criticized these moves as undermining local customer loyalty and regional presence, The government defended the consolidation as a step toward efficiency, scale, and sustainability. Through it all, the legacy of 1969 remained intact. The very idea that banks should serve the people, not just profit, continued to guide policy making. Legacy of 1969, a landmark in Indian democracy. More than 5 decades later, the nationalization of banks is remembered as one of India's boldest socio-economic reforms. Its legacy can be summarized through a few transformational outcomes. Financial inclusion. Millions of Indians received access to banking, savings, credits, insurance, remittance for the first time. Agricultural and rural development. Nationalized banks were the financial engine behind India's green revolution, food self-sufficiency, and rural self-employment. Women and marginalized empowerment. From SHGs to Mudra loans, the structure created post 1969 supported underrepresented groups. Confidence in public institutions. Despite challenges, Indians trust public sector banks. During crises such as demonetizations or COVID-19, PSU banks became lifelines for millions. National pride. The move was a statement that India's economy would be driven by inclusive growth, not just industrial powerhouses. Words from the architects. Indira Gandhi, speaking in parliament shortly after the move, said, "Bank nationalization is not an end. It is the beginning of a new chapter where we place the instruments of growth into the hands of those who need it the most." Dr. Manmohan Singh, reflecting later, noted, "While reforms were necessary, the vision of 1969 gave India a foundation no other developing country had. We didn't just build banks, we built trust." Lessons for the future. As India moves forward into a digital age, the lessons of 1969 remain relevant. Finance must be inclusive or growth becomes unequal. Banks are not just financial institutions, they are agents of social justice. Public confidence is the true currency of banking. Accountability and autonomy must go hand in hand. As debates continue around privatizations of public banks, many economists and policymakers argue for a hybrid model where banks will operate professionally but with a strong social compass. A monumental moment, forever relevant. The 19th July 1969 was not just a date, it was a declaration. It declared that India's growth must be for all, not for a few, that villages mattered as much as cities, that the poor deserved not charity but credit, that in the new republic the economy would not just be run by corporations but guided by conscience. Over 50 years later, as India continues its journey as a growing global power, the echo of that midnight ordinance still rings in the hallways of every bank branch that dares to put people before profits. The revolution may have started with ink and ordinance, but it grew with millions of hopeful signatures and mud-stained passbooks and the steady steps of empowered citizens walking into banks for the first time. Thank you very much for your patience. Request for like, subscribe and share.